Good afternoon, everyone. Marty Missouri here, the 22nd of May, 2021, with your weekly macro update. Just a few charts to show you this weekend. We took just a minor step back on our index, first down week we've had in a while. All of it in housing, which was interesting, but no big deal. And I'm not bearish on housing. It's quite the market. There's legitimate concerns around the cost of what it takes to build a house. We'll talk about that in a second. Then I want to talk about a little bit about tech. I want to update our technical analysis of the tech sector, also of the ag sector via our ag futures ETF. That's a not small position for us. And then I want to do just a quick technical look at the S&P 500 index. So without further ado, here's our index. You can see we just ticked back a little bit this week by about 4 points. We're now at 44.90, which is still very good, very positive. So, nothing goes up in a straight line. Kind of looks like our commodities chart, which I've been showing you and telling you that we're due for a correction any day. So you'll see that's taking place right now. So still definitely looking at a positive trending economy overall. Weekly mortgage apps, purchase index. These are not refinances, these are just purchases. So as you can see, after we had just a little bit of an uptick here last week, really came plunging lower, just about establishing a lower low. So from a technical perspective, this is pretty bearish for mortgage apps. Lower highs, as you can see, lower lows, and quite the negative rate of change as well. So we know what's going on in the housing market. In fact, let me continue that as we jump over to housing starts. I wrote a little bit about this one, spent a lot of time on that, but we did see housing starts take a pretty good dip, 9.5% on a rate of change basis. Housing permits actually were up slightly, but take out multifamily complexes, apartment complexes, and just focus on single family permits were down 4% as well. So the price of lumber, we've talked about that. I've illustrated that for you a couple times on the blog, on the written blog. Just really applying quite the headwind. From what I understand, projects are being put on hold. What contractors have to pay for wood these days is quite frankly astronomical, if they can even get it. There really isn't the supply out there to remotely meet the demand. So we'll see how this plays out going forward. You have a very easy credit market. The Fed is buying up mortgage-backed securities. In fact, it's just amazing. They've been doing more asset purchases now that the economy is beginning to pick up than they were in the some of the throes of what was the worst last year. That speaks to our thesis, which is at odds with some other people's thesis, of course, it always is, that the Fed is really as interested, if not more interested now, about what happens when they pull back to asset prices and what that does overall to an economy that really is levered towards asset prices. So fascinating to many people that not only are they not tightening, they're actually kind of stepping up. This last month, the month of April, there was actually greater Treasury purchases by the Fed than there was Treasury debt issued by the federal government, which means, of course, they're out there buying existing treasuries. And my contention has been that they will manipulate the yield curve like they had to do in the 1940s with yield curve control. And some believe that they're actually doing that stealthily right now without actually announcing it. But that's a scenario that is exceedingly bullish for inflation, crazy bullish for gold, very bullish for tech stocks, frankly, because they're the longest duration stocks, meaning they're the most interest rate sensitive right now. And of course, all things commodities, if indeed that's where we go. And that's a good segue to our next chart, which is that Bloomberg Commodities Index that I've been showing you for several weeks in a row. So we had this bull flag pattern, pretty classic, right? We clearly had one right here as well. And typically, as I show you each week, what you look for is the length of the flagpole before the next consolidation begins. So right now, this looks like a failed pattern because we're beginning to roll over, and we didn't make the length of this particular flagpole, right? Stop maybe halfway. Now, I've been telling you each week that this trajectory was unsustainable and that any day now a correction was coming. So we're kind of forming the same pattern. Of course, this was an opportunity for all the commodity bears and the deflationists, or the people who don't share our thesis or our concerns about inflation going forward. We're saying, see, people are talking about commodity super cycles, yada, yada, look what's happening. Well, I am talking about a commodity super cycle. It's just a long-term commodity bull market going forward. Provided a lot of data as to why I think that, but truly, I'm not wedded to that thesis. It just makes a lot of sense to me right now, and it also makes perfect sense as any asset class that has this kind of a run up, is that it needs to consolidate those gains and correct those gains, and could even come down quite a bit further. Right now, it's looking like more of a flagging. So you come out here a little bit, and you break out. You could break down, paying very close attention to that, and I think in the near term that's very, very much a possibility. Right now, we've added a little hedging on the ag side, which is not a small part of what we're doing in commodities, but we haven't in the areas of metals and other commodities, at least not at this point. But folks, just suffice to say, in this environment, we need to be very dynamic. Number one, as I keep preaching, our objective is to just compound returns at a reasonable rate and not lose any money, right? Or mitigate the big downturns. When the ice cracks and potentially breaks like it did last February to March. So there's where we're hedging broadly stocks, narrowly agricultural commodities right now. And these are things that you can do cheap on a relative to the size of a given portfolio. So again, as we move forward, and as we need to diversify more into areas that make sense and have a better risk reward setup and so forth, when they have huge runs like this, we have choices to make. Do we cut the position, maybe pay some capital gains taxes? But if we're not bearish and it's not an overwhelming weighting in the portfolio, even with the gains when other things have gone up as well, do we just allow that corrective action, which is fine, right? Or do we hedge it a little bit if we think something severe could happen to the downside? And that's what I explained last week when we looked at ag. But right now, I like it a lot. I think this is very healthy. I think it definitely could come down further, could also break out to the upside. Time will tell. Then, of course, the other chart I've been showing you for weeks now is copper. Again, up, create that flag, up a bunch, create that flag, overshoot, come down, consolidate. I can turn that into a flag. So this, there's your flag pull. There you go. Just pretty much right on the money. That's a steep decline now. So now that doesn't look like the pattern you'd expect. You wouldn't expect just that kind of a fall off there. You still have the same kind of overshoot. Now, if we start doing this right in here, then we can have that nice technical pattern. But that would have the copper would have to bounce pretty nicely right here. So we'll see. China's been concerned about the price of commodities rising. There's some sentiment that's growing within the Bank of China that they should actually take measures that would strengthen the yuan, right? And in Chinese terms, lower the price of metals, and other commodities. But I think I've made this case on the blog. I've certainly been making it in client reviews, that China's whole system is changing right before our very eyes, and they've evolved into a service-oriented economy as much, if not more so, than a manufacturing-oriented economy. And they have a civilian class who is making more money and wants more out of life. And so now it's more consumption-driven, more focused internally and that sort of thing. And so that feeds into our longer term structural inflation thesis. And again, there's some very smart people who are not in our camp, and I've been really studying their position as well and getting my head around it, which was pretty much my position up until recently. My view is, I appreciate it. If I were still in that camp, I'd be just stuck in that traditional textbook thinking and not really paying attention to the broader picture, which is some of these geopolitical developments that are going on, as well as what's going to be going on with just simply money supply in the US combined with just huge fiscal spending going forward. Now, something else that comes to mind was an article I read this morning where the Democrats are just having a terrible time getting their, what was originally a 2.2 infrastructure spending bill passed. They thought they were compromising down to 1.7 with the Republicans, but that's not going to fly either. So that sort of news could provide a real headwind as well. So, and what's going to happen, right, in terms of activity and upward pressure when the extra unemployment benefits expire, right? When it's just obvious that we can't continue just to flood money into the system. Now, I say that, and immediately I want to say, however, if they don't continue to flood money into the system, well, then asset markets they're gonna roll over. That I'm certain of, and then they're gonna jump right back in there and turn on the fire hoses again. So essentially, the way to look at it, if they start draining liquidity or slowing the liquidity pump, which really explains so much of what's going on out there. When $10 trillion worth of new money hits the global economy, by the way, the majority of that in the US, you're going to get insane things going on, like things like a cryptocurrency that goes to $65,000 a coin. These phenomena would not be there to happen without all of this excess liquidity needing a home in the global marketplace. The housing market, of course, that explains that, right? Commodity prices to a great degree explains those. Certainly explains the stock market at all-time record valuations, and seemingly nowhere to go but up. So without that liquidity, or even just the hint that they're going to pull back on some of that liquidity, these things have to roll over. So that's the last of my charts for the inputs. There's 49 inputs that we look at, but that's enough to show you, at least today. I think you get the point. Before I get into the technical analysis, I just wanted to another point that I thought about this morning. So I was reading some pretty deep and long analyses by two different really good macro strategy firms, right? And these are folks who can charge quite the premium for their stuff. And while we do our own work, and as you can see, we crunch the data ourselves. We have our own models and our own our index and so on. So I think you do have to do your own work. There's no conflicts of interest, which is what defines Wall Street and so on. But it's interesting. So just the two that I've read so far today. It really is fascinating to read between the lines, and when you can get a clue for where the analysts and the authors of these things are coming from, you realize their bents, and it's so fascinating to see it show up in their reports. And so what I mean is, when you're bullish, there's just going to be a bullish tint to the data that you show, and a bullish take and a bullish spin. When you're bearish and you think that things are going south and the world's a scary place to be, you can write an equally long analysis on the same day looking at the same data. And it's amazing how you read that one and you're just profoundly bearish, because you think they're painting a real negative picture and they're proving why they feel that way, and it's not a bias and it's not their personality, it's the data is telling them that. So we're all human beings, we all have our biases, there's just no way around it. So if there's one thing I preach to everybody at PWA, is that we have to overcome those biases, and we have to see the world for how it is, not how we want it to be, not how it relates to how we're positioned at the moment. We don't position our portfolios and then construct the narrative to fit the portfolios. And I do think that happens, and we kill ourselves so that doesn't happen here. We actually look at the data and then construct the portfolios to match the data and the trends and so on. So just to tell you what I'm talking about, the optimist of the two, and I'm just going to read because I think to be fair to them, I'm being critical, and I think they should be left anonymous. But they are exceptionally good at parsing the data and giving their analyses, but have their bent. So this is the clue to one of them this morning, and this would be the optimist. Maybe we're stretching here, but even the chart of the S&P 500 looks a little like a crested wave crashing against its 50-day moving average. And here's what I'm talking about. let's just hope the 50-day moving averages foundation is strong enough to hold the weight of the water. Exclamation point. I read that and I think, fellas, gals, you don't want to hope for that. You want to, because if you hope for that, you see that, you want that, and you're looking for excuses for it to be that, right? And it could skew your analysis. There's no hoping. It's looks like a crest, and it's crashing down on the 50-day moving average. It's holding at the moment, but it may break. And so we're watching and parsing the data and looking at the factors that would help us understand, or would help us anticipate whether it's going to break or whether it's going to go higher, and then what to do about it. Not, let's just hope that it's strong enough to hold, right? So there's that. Same date, each one is credentialed to the max, right? But this one, and I like the guy. This one's an economist. He has quite the team. And here's just one simple paragraph. All the Biden team has done here is create the conditions of a boom-bust economy. And in April, it came with this retail sales report. With all this data, volatility, and uncertainty, the Fed has no choice but to stick with the program. Now, I do happen very much to agree with that last sentence. The Fed has no choice but to stick with the program. But he's really referring to weaker than anticipated retail sales data and other things that he sees not positively like the other firm does. My view in terms of the Fed has no choice but to stick with the program is because it's not about the data that's coming in. It's because if they don't stick with the program, they're going to crash the markets. And if they crash the markets, there's going to be that wealth effect, and people are not going to feel as wealthy, and they're going to pull in, and it's going to get really, really ugly. But they boxed themselves into the most unbelievable and really, in some sense, inexcusable corner. They should not have allowed themselves to get there. So while people are saying the Fed are going to tighten and blah, 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 they may be right, and that means the Fed's willing to crash the markets. I don't think so. I think they're wrong. I think the Fed is going to find excuses to not raise interest rates, to not slow down their bond buying to any meaningful degree. And I just think the CPI numbers are going to continue to come in conveniently below what inflation is really doing. And I do emphasize conveniently, and let me add suspiciously conveniently, because rapid inflation showing up in those metrics, it would be just horrific for the Fed, because the world would be screaming at them to do something to slow it down, where we're living in the 40s again, where we have 130% debt to GDP, and we have a tremendous amount of fiscal spending coming, which is going to raise that debt ever higher, budget deficits and so on. And they can't let interest rates go up against that newly issued and any debt and any of the debt that's rolling over. And I haven't even started on the $11 trillion of debt that's on corporate balance sheets, which I won't go there in this video. So you read through the ladder, and it just, you want to go shoot yourself when it's all over. The other one, hey, we're going up, right? Or things look really, really good. Our assessment is, our index says things look really, really good, but our critical thinking says has to, right? And it looks really, really good because there's $10 trillion and more of it growing by the day that's been injected into the economy. So then we have to ask ourselves, I think I do this every week on here, is what happens when that liquidity begins to dry up, right? Well, they're going to keep it from drying up at the moment. At least that's my thesis. Hence, the diversification, the owning things like commodities, which prior to late 2019 we hadn't owned in a long time, and then the hedging, both broadly and then strategically as we go. So once again, we can compound at a decent rate and mitigate the big downturns when they come. And I highly suspect that some are coming in the not too distant future. Okay, so that technical analysis I was talking about, the tech sector itself, this is our tech exchange traded fund, 5% of our U.S. stock market weighting. The other day on the written blog, I showed us breaking down here on this support line, bouncing off of that. I said, feels really need for this to come back and break back above that 50-day moving average. Well, sure enough, we've come back, bumped against it, bumped against it. Thursday closed above it. That made me optimistic for tech. Friday closed just a hair below it. And you can see how this trend line is beginning to kind of roll over. And we've had these divergences pretty stark, right? It's lower highs and the momentum divergences with the rising wedge pattern, which just seems to be all I'm showing you here lately. So we'll see. We break down next week and fail that 50-day moving average. I think we can shoot through these two support lines like the knife going through butter. So we'll see. It doesn't have to happen that way. Again, we could definitely go back here, regain this. And that's pretty much been the story. Is, you can see we've had these pretty good corrections here. That probably approaching 10% in here, and then bounce, and then recapture it, and off we go. So maybe it's just that again, or maybe there's something bigger on the horizon. We'll see. This is showing here, that bouncing off of that, and that's actually positive the way that histogram is beginning to turn up. And then DBA, our commodities futures, ag futures ETF that's been so very good to us since we bought it. So I said last week, I said if it breaks down below this trend line, that's going to be a sell signal. And last week we had literally stopped right on it on Friday. We can see we had a nice gap up off of that. Typically gaps are filled, so ultimately that would say this is coming up, but then did lose the trend line. Right, and last week I said we break through that trend line and we break through this 50-day moving average. That's going to concern me for something more precipitous, and we do have a hedge right in here with put options at about $16 a share, which would, again, we could certainly survive that with all the gains we've made. We could survive anything, but I know commodities can take, just like stocks, can take huge hits from time to time. But this is kind of encouraging, but you can see now that trend line, what once was support becomes resistance. So we'll see how that plays out. The slope of the 50-day moving average is still positive. And then the S&P 500 index, just the broad market. So we've been living in this upward sloping wedge, which is by itself a bearish pattern, but boy, it's really bearish in a meaningful way when you have these bearish divergences in the momentum indicators. And same kind of thing, you have this upward trend line. There's several that you could draw one here too, which would actually capture more points. But if you break down below that one, and you've got your potential sell signal, that 50-day moving average. And that's what I was just telling you about that other firm. It looks like a wave and it's cresting, and if it wants to crash through that 50-day moving average, frankly, it's fine if it does, right? As far as I'm concerned, we want the market to do what the market needs to do. They said we hope it holds and goes higher, and it may very well. In fact, I wouldn't bet against it in a big way. I would hedge against it if I were managing other people's money, but I wouldn't make a big bet against it either way. So I would hedge against the down, is what I'm saying. So I hedge against the up just by being long stocks, which we are, of course, as well. So breaking down below this trend line, testing the 50-day moving average is something that has the bull's attention, make no mistake. Where would there be stop losses that would be filled? Right here below 39.42. So if we were to drop down below here, folks who use stops, no doubt, some stops would trigger. And stop losses just exacerbate the downside. So we'll see. We'll see how that plays out. Also on this might look familiar to some of you. These circles up here, they correspond with where our 10-day average volume line, this yellow line, comes down and either touches or almost touches this threshold right here. And as you can see, that has been at times some danger zones. And why do I pay attention to that? Well, when prices are rising, that's great if you're long the market, if you own stocks. But if you own stocks, you want to see good volume while it's going up, right? Not declining volume. It's not unusual to have declining volume on an uptrend, even in a bull market, but you don't want severely declining volume. What that means is lack of conviction. It's not that everybody's rushing in and buying and pushing stocks up. It could be a very small number of buyers. It could just be that the sellers aren't willing to sell at yesterday's prices, and that by itself would push the market up, right? But when we have these periods, right, they tend to sometimes be followed by some corrective action. Not really much there to speak of. Yes, there, right? Yes, there, right from there. Big time right here. It's just this building, just complete lack of volume. That tells us that that last thrust before the big downturn, 30-some% here, was all on really low volume. But that had been building for a while, right? Look at here, really low volume, and then kaboom back in 2018, and that was a 19.8 or 19.9% drop top to finish. So again, just something else to look at, something that has our attention. You could lose a lot of money shorting every time our indicator touches that line, right? But again, one of dozens upon dozens of factors that we look at. So folks, I will leave it there. That was probably a pretty long one even after I edited it. Lots more to come, no doubt. Hope you have a great rest of your weekend. Talk to you soon. Bye-bye.